Hey, friend, welcome back to the Live Off Rents show, where we bring in real estate and other financial experts to help you build passive income, create your dream lifestyle, reach financial independence, all those other things that we all want in our lives. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I'm on this journey with you, investing my own money with you guys every month in our co-investing club, looking at different passive real estate deals, group investments. And today I am really excited to introduce our guest, Chihiro Kurokawa. He's the director of ZT's corporate private equity practice. After starting with a career in real estate private equity and syndications, he has helped raise capital that enabled $29 million in real estate acquisitions and nearly 600 multifamily units. So Chihiro, welcome to the show.
Thank you so much. I really appreciate the opportunity, Brian, to chat with you today.
Well, me too. It's not often that we get someone in corporate private equity here. In fact, I think you're the first person that we've ever had on the show to talk
Nice.
about corporate private equity. So I'm excited to learn more about that and how that compares to passive real estate syndications. But let's start at the beginning. How did you get into real estate in the first place?
Yeah, so my origin story is pretty similar to a lot of people who got into multifamily syndication, which is to say, I had a corporate career. I was doing analytics for a very large automaker, and just found that to be a little bit lacking in the fulfillment department. And so started investing first as a limited partner in multifamily syndications, then joined a mentorship group, and eventually, through a lot of hard work, was able to take down my first deal, which I closed the purchase of in 2019, early 2019. And then from there, went on to do three more deals. And so I've sold out of two of those and currently own and operate two multifamily deals.
Awesome. Well, one thing is that I always love to hear from people who have syndicated deals is just how they made that transition. It sounds like you actually did not start with single family or small multifamily the way that a lot of people did. It sounds like you went right into syndications, but
Uh-huh.
a lot of our audience members, they're interested in the idea of syndicating a real estate deal as a general partner, but they don't really know where to begin. So, can you tell us about how you did that first deal and what some of the challenges were, and how you got over that hump to do your first syndication deal?
Yeah. I'll start by saying, Brian, I have over the years talked to many people who are very established single family investors. And so I'll be talking to somebody and they're like, yeah, I own 80 houses, 40 of them are free and clear, and on and on and on. And they're asking me about how to get into syndication. And I'm like, hey, listen, you own 100% of 40 small deals, and I own a very small percentage, maybe single digit percentage of a larger $5 million deal, right? So there's always pros and cons. And so one favorite quote of mine is, there are no solutions, there's just trade-offs, right? So you could be that very established single family investor with a significant portfolio, and you have 100% control over that. And there's something to be said of that, right?
Sure.
But I think that there is some element of sexiness to saying, oh yeah, I operate a 150 unit property, or I have 700 doors under management. And so I think a lot of times people don't realize, they think, the grass is greener elsewhere, but some people really can just look at the mirror and say, gosh, I own 12 houses. Like that's pretty darn good. Like I've got significant equity and I'm generating significant passive income. I think they should take a measured look at the pros and cons of what they do now versus what they think they want to get into.
So, how did you go about doing that first deal? Getting the financing lined up for it, raising the capital for it. I think those are two areas that a lot of people who are curious about syndicating
Yeah.
have questions about. And then, of course, there's a whole nother conversation around like how to actually find and underwrite deals. But let's start with just how you went about finding the financing for it, and then how you raised capital for it,
Yeah.
how you paid for it, in other words.
Yeah, it sounds trite, and it's maybe overly repeated, overly so, but it's because it's true, which is it's about networking, and relationships. You got to shake a lot of hands and meet a lot of people before you can establish those relationships and find that mortgage broker who's going to get you a commercial loan, or an attorney who's going to do the transactional work for you. Are they also going to do the securities work? There is a lot to it, but it's not rocket science. You just need to have the resources, and really the discipline to go out and meet the people that you need in order to close on a transaction like that. You also asked about how to raise the capital to close a deal. So my first deal needed about 3 million in equity to close. And so what I did was really a little bit of faking it till you make it, but talking to people who I thought were good prospects and saying, hey, I'm partnered with some people who do have significant experience, hundreds or thousands of doors. These are my operating partners. They're going to help me run the deal. And this is what a deal might look like. Would you be interested? And keep those relationships warm. And then when it came time to actually run and gun, then start making a lot of phone calls, you know. And so on that first deal, I was able to raise a little under 700K, primarily friends and family. And I had operating partners who raised the bulk of the equity that we needed to close that deal. And then so we co-managed or operated that deal.
So you were not the lead GP on that deal. You were a co-sponsor of that deal.
I
Is
would
that
say
correct?
that I was the lead asset manager, and I found the deal. But with regard to, but I had three partners, one of whom was my mentor. Yeah, and
So they helped raise capital alongside
yes,
you
absolutely.
in
But I
exchange
was
for a
the
piece of the pie.
That's right, and I was the primary asset manager. Though I will say I got significant help from my partners in that regard because I was new to the game.
Yeah, no, and that makes perfect sense. And most of the sponsors who I've talked to, for their first deal, often for their first few deals, they're going in on these deals with other sponsors, many of whom have a lot more experience and much broader networks for raising capital. And that helps you get those first few deals under your belts, establish a name for yourself. It's funny, one word and one theme that I heard as a recurring theme in what you just said there was relationships. And this
Yes,
business, like most businesses, it really is all about relationships. And in this conversation that we're all having as a society right now around AI and oh, like which jobs are they going to take away? AI can't replicate those relationships that you build with other people in
that's
this
right.
industry, right? So if part of the value that you are bringing to the table, whether to your employer or as a self-employed business owner, if that value comes from relationships, you probably aren't under too much threat from AI, right?
Right.
So something just to consider. All right, so you syndicated these deals. Let's talk about the arc of your real estate syndicating career, and then how and why you transitioned into corporate private equity.
Uh-huh. Yeah. So I continued working my corporate job as an analytics manager while syndicating, and so I grinded. I'm not shy about saying that I worked on weekends. I woke up very early on mornings. Worked before work, right, and worked after work, and that's a familiar story with a lot of people. Real estate investors, for the most part, or virtually all of them, are real hustlers. They work hard.
You have to be.
Doesn't you don't It doesn't matter what you're doing. Syndicating, you're a wholesaler, you're doing flips. You're generally a very, very hard worker.
Yeah, it's,
Um,
it's a side hustle. I mean,
yeah,
yeah.
yeah,
Until you quit your full-time job, if you
yeah,
quit your full-time job.
yeah, yeah. So I did do that in it was May of 2021. So really exactly 3 years ago. And so I was focusing full time on the real estate investment business, multifamily, and then also started up some single family on the side as well. Quickly learned that I wasn't cut out to do the single family business, and so one thing that really, two things that really motivated me to make that transition, Brian. One is we started seeing some headwinds in multifamily, right, with interest rates going up, and right now we're seeing a lot of the impacts of that on commercial real estate. And secondly, I got really darn lonely, like being a solo entrepreneur, working in my office in my home. And so
I know how that goes.
I didn't realize that I was going to miss anything from my corporate life, but I realized I did. And it was working on a team. Even if I didn't like the work, which I didn't a lot of the time. I certainly enjoyed the people that I worked with. They were good people, you know. And so with those two motivations, I started looking for some sort of way to add value to in an institutional context to maybe a real estate private equity firm or something of that nature. And I'm just fortunate that I ended up finding the right fit at ZT Corporate, which is, as you mentioned, a corporate private equity firm. Now, we have done a fair amount of real estate through the course of doing healthcare investments. We've built facilities, we've done gut rehabs, we've done expansions, we've built dealership facilities and the like. And we built our a Class A office building that ended up being our headquarters for a number of years as well. So we do have experience there, but really our bread and butter is operating businesses. And so I found that opportunity very compelling in that I would work on a team, a really high-powered team that executes, which is exciting to me, and move into some asset classes that I didn't have exposure to. So that was all very interesting and exciting for me. So that motivated my move.
You know, it's funny. I've interviewed a lot of people who have retired early or for some other reason, quit their job, their full-time job. And a recurring theme that I see in that is a lot of people are surprised when they miss the social interaction from their work. They miss the structure, and just that
Yeah.
daily structure, having somewhere to go, having somewhere to be, having, a routine, day in and day out. People miss that. And they don't think that they will miss it until it's gone. And then they're like, oh, I've spent this entire day and I haven't talked to another person. I haven't seen another person. Like,
Yeah. I
it's something
mean,
I've talked to my father about that a little bit recently because he's pushing 70 and still working full time, but he's starting to talk about retiring, and I think he's in for a rude awakening with some of that stuff.
yeah.
Anyway, not to go down a rabbit hole.
You perfectly encapsulated like my mindset at that time. I literally got chills down my spine as you were saying that because you just hit it right on the head for me. Like that was exactly it. Couldn't have said it any better.
Well, it's one of the things that Denny, my partner, and I, we talk about all the time, on our podcast, on the blog, is how we've interviewed many, but probably 100 people who have retired early, and they all went back to work. I mean, every single one of them went back to work sooner or later, because there's only so long you can sit on the beach sipping pina coladas or playing golf or watching TV or, traveling. You get bored, right? So,
Yeah.
what do? People go back to work. Now they go back to work on their own terms,
Right.
whether that is starting their own business or going and working for a nonprofit or working for a corporation that really fits their values or whatever it is. They all go back to work though, because
Yeah.
there's only so long that you can sit around by yourself, not working if you're in your 30s, 40s, early 50s. So, just to tie that thought together, most people get really upset when they hear that. People who are like pursuing financial independence and they're like saving 50% of their paycheck, they hear that and they're like, well, why should I bother? Why should I bother saving all this money if I'm just going to go back to work? And my response to that is, this is actually good news. This means you don't need as much money as you thought you needed. You don't need to actually reach financial independence. You just need to cover any gap, any shortfall between what your dream work pays and your target living expenses, which is probably a pretty small amount of money, right? So you don't actually need to save up $1 million or $2 million or
Right.
$3 million. You just need a little bit of passive income to bridge that gap. And you can do
Yep.
this tomorrow. You can do this next year potentially.
Yeah.
So anyway, I'm getting up on my soapbox. I'm gonna I'll step back off. Uh, so okay, so you are doing corporate private equity. I'm intrigued by this. So,
Yeah.
can you tell us a little bit about some of the investments that you guys are offering to passive investors, to limited partners?
Yeah. So our core verticals are auto dealerships, healthcare, and commercial real estate. So healthcare is how we got our start. We were founded in 1997, and the dot-com bust was 2000, right? 2000 into the year 2001. So, and generally real estate investors resonate with this. We like tangible things that generate operating income. We're not generally huge stocks and bonds people, and it's because there's something intangible about that, and there's a lack of transparency too, right? When you own stock in something, you really don't get great insight into the operations generally. So through that experience, we went into healthcare private equity and started with imaging facilities, then surgery centers, sleep centers, urgent care, hospitals, you name it. We've done a ton of different businesses in healthcare. Currently, our focus is on something called freestanding emergency rooms, which is a business model that is unique to a limited number of states here in the US. But here in Texas, where we are headquartered, we have 27 acute care facilities. So that's 25 freestanding emergency rooms and then two something called micro hospitals for a total of 27 facilities. And we're the state's largest owner operator of those. And so what we do is we raise equity when we have an acquisition and are looking to add to that portfolio, which we likely will do at some point this year. Then we raise common equity for that. And then we have a preferred return that is in excess of any preferred return that I've seen in commercial real estate deals. And so it's really, I think, a compelling passive income opportunity, and especially for people who might have a lot of exposure to real estate in their portfolio because they're themselves a real estate flipper or syndicator. There are ways to invest in private offerings outside of real estate where you can limit your exposure to those cyclical factors and really not give up anything in terms of yield or return.
So there's a ton there that I want to dig into. I'll start with the simplest question that I have. You said that the preferred return on the investments you guys are doing is higher than what you typically see in real estate syndications. What broad range are you guys generally offering as a preferred return on these investments?
Yeah, so they start at 12% and go up from there once they're tiered, right? So that's not common in private offerings, wherein if you invest a greater amount, you get a greater preferred return. But yeah, they start at 12 and go up from there, up to 15% per year.
Based on the amount that the person is investing.
Exactly. Yep.
And do you guys allow non-accredited investors to participate in these deals?
Unfortunately, we do not. No, it's accredited investors only. Good question.
Gotcha. Okay. And what I'm guessing that people listening to this are thinking right now is, they probably understand how to analyze risk on a multifamily syndication or some other real estate syndication, but how do you analyze risk in some of these other businesses that maybe they don't have any familiarity with, right? So I mean, I don't know anything about car dealerships, right? I don't even own a car anymore. So how would someone like me, or likewise, I don't know anything about the healthcare industry. So how would someone like me go about analyzing the risk inherent in these businesses when I don't know anything about that industry?
Yeah. So when I made my first LP investment in a real estate syndication, it was a multifamily deal in Decatur, Georgia. I knew very little about apartments at that point, but at some point, right, you've done your due diligence, you've gotten references. You're like, hey, is this guy legit? You have those kinds of conversations, and you at some point it is a leap of faith for you, right? So that's one thing, and a lot of times the fundamentals are fairly intuitive. So let's take healthcare for example, and specifically a subset of that, which is emergency medicine. Intuitively, okay, in a recessionary environment, if I sprain my ankle, am I going to not get care for that? Or would the typical American consumer, avoid getting their fracture taken care of? And we obviously know the answer to that is no. So I start with those sorts of basics, like, okay, so what would set this thing, potentially turn this thing sideways? I will tell you right now, Brian, one of the greatest impacts to emergency medicine is really regulatory. So the regulatory environment can change, and that can affect things like billing, For example, and that in fact did happen within the last couple years. There was legislation called the No Surprises Act, so that reduced our revenues a little bit. Fortunately for us, we knew that legislation was coming down the pike, so we underwrote accordingly. We had a deal under contract to purchase, and we said, "Hey, that's great that you're making these kinds of revenues now, but we know this legislation's coming down the pike. You know, we're assuming a 10% cut." And so that's how we're underwriting this deal. So we were able to adjust in that regard. But you know, some of this stuff is going to be intuitive. And then in a lot of ways, your due diligence is going to be the same as a commercial real estate deal, wherein you're going to ask to look at the financials, and you look at that. You may not have seen a P&L from a healthcare company before, but you know how to read a P&L because you've underwritten multifamily. You've looked at dozens or hundreds of T12s, right? So that's a P&L for an apartment complex. So I would say that I would venture to say it's not all that different. You just need to do a little bit of research, maybe get some references, and you know, at some point, take that leap of faith and make an investment.
Well, I love that your company's focus, that ZT's focus, is, you know, in some ways similar to private equity real estate syndications focus, tangible things that produce operating income, right? You know, and that, like you said, that is something that LPs or passive investors who have experience investing in syndications can carry over in analyzing these other very tangible businesses with a physical real estate footprint and, you know, ongoing revenue. So Chihiro, if someone wants to learn more about ZT, maybe invest with you guys, how can they connect with you and learn more about what you're doing?
You know, the hardest thing about connecting with me is spelling my name correctly. So I'm available on LinkedIn, on Instagram, all the socials. My first name is Chihiro, Chihiro. I always tell people Chi like Cheerios, hero like Superman is how you pronounce it. And my last name, Kurokawa, Kurokawa. I'm not actually hard to find.
Well, Chihiro, thank you so much for coming on here. This was an eye-opening interview for me anyway, as someone who has never invested in private equity or corporate private equity. So thank you for coming on and telling us about it.
Thank you so much. I appreciate it, Brian.
And guys, if you enjoy these conversations that we have, please rate, review the show. Means the world to us, makes a huge difference to us. And we will catch you same place, same time next week. All right, bye for now.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have averaged returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rental's Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.